looking at large resources, I mean, it's really obvious that if things are very bad, your clients are very cautious. It's very hard to look past BHP and Rio at the moment, both teetering on buy territory, so that we've got a hold on both. But obviously, they've come back really fast in terms of valuation and starting to test that discount to our targets for both by a similar amount. But BHP in particular, which has been my favourite for several years now, not always, but for a long time now, has been my favourite because of the energy exposure, has come back just a bit harder and sitting at a bit more of a discount. You've still got a 6.5% yield, and really the prospect that in the August result, if conditions have stabilised on the demand front, then you've got the prospect for a catch-up dividend given the strength of their balance sheet and how much cash flow that they've retained in the business. So, just below 5 times EBITDA, very competitive globally. The one big thing I would point out is yesterday I took part in an Analyst Roundtable with Rio's CEO, who's presenting to Morgans tomorrow morning at 8:45 Brisbane time or 9:45 Sydney, Melbourne. He was saying that they are very cautious on this current half. So while the whole sector agrees that the second half of calendar 2020 will see a big stimulus-fueled rebound in demand, and that they are quite concerned in just the short term and what's happening there, and especially in terms of steel productivity, which has real potential to drop a bit. So I did put that in the flash in detail, but if you do see a fall of the iron ore price, that would be a bit of a headwind on a bounce that we could see across broader markets, obviously, this week. But we'll have to wait and see. So, but even with that in mind, and the murky picture we have for the next 3 months, my approach is pretty much unchanged to BHP and Rio, and that is just to accumulate very slowly. Just don't try and pick, catch a falling sword or pick your anecdote. It's all going to be pretty accurate at the moment. But just be patient and just wade in very slowly, because I think weakness in the iron ore price would drag on those big miners. Woodside, clearly our number one large cap energy pick, has come back quite swiftly. I get the impression global funds have been selling as well, which has been adding to that weakness that we've had recently. So a similar multiple to BHP and Rio, 5 times EBITDA, 6% yield as well. Obviously robust balance sheet, 12% gearing, and really the most defensive energy player we have. So that's certainly the best pick in this environment for the more defensive type client. If you want more leverage to a rebound and more growth orientated stocks, then we're promoting, Max promotes Beach. Max covers Beach, which is our top mid cap pick. Max said to me that there's no net debt in the business. Exploration wins haven't been baked into his positive numbers. Cash flow will fund the vast majority of their capex growth plan, even if the oil price is at $55. So very safe pair of hands, and obviously has become a bit of a default oil name in that mid-cap space, like Aussies in copper. So that would be the one in a sharp recovery that you would expect to really outperform, and we've got a buy on it. And then the mining equivalent in my coverage of that is South32. Net cash on the balance sheet as well, very healthy cash flow generation and low risk business relative to the likes of Fortescue, where Fortescue almost 100% or it is 100% of sales go into just China in one product. For South32, it's an immensely diversified business where only 22% of its sales go into China. So a bit more defensive there, especially with coal having already corrected and base metals.